Here's the uncomfortable truth nobody wants to admit. The Federal Reserve's latest interest rate cut is essentially meaningless for the millions of Americans barely scraping by each month. While financial headlines celebrate the Fed's quarter-point reduction announced on September 17, 2025, the harsh reality is that families living paycheck to paycheck, which represents more than two-thirds of American households, won't feel a penny of relief anytime soon. But here's where it gets controversial. This rate cut might actually be widening the gap between the financially secure and the financially vulnerable. Key takeaways that will shock you. The majority of American families won't experience reduced borrowing expenses in the immediate future, particularly when it comes to credit card debt and fixed-term loans that dominate their monthly budgets. While nearly two-thirds of Americans claim they factor in interest rates when selecting their banking institution, those struggling financially remain completely exposed to existing high-rate debt. Buy now, pay later services are experiencing explosive growth as desperate consumers scramble for alternatives to conventional credit options, providing temporary relief but failing to address the underlying crisis of expensive borrowing. The Federal Reserve's decision to trim rates by 0.25 percentage points, a move that financial experts had anticipated for months, might appear promising on paper for American households. However, the critical question remains: how quickly will this adjustment translate into actual relief for everyday family budgets, especially when considering that over 67% of consumers are trapped in the paycheck-to-paycheck cycle? And this is the part most people miss. Consumer finance data and comprehensive research from PYMNTS Intelligence expose a troubling reality. Even with financial analysts predicting 2 additional rate reductions in the coming months, the genuine challenge lies in determining whether these policy changes will ever meaningfully impact the heart of consumer spending and household debt responsibilities, particularly the crushing burden of credit card balances and automotive loan payments. Earlier this year, detailed analysis highlighted the ongoing struggle American families face with elevated interest rates. The emerging narrative reveals a stark divide that policymakers seem reluctant to acknowledge. Financially stable households view rate decreases as investment opportunities and wealth-building moments, while paycheck-to-paycheck earners continue suffering under the weight of existing high-interest obligations on essential credit needs. The financial squeeze that won't let go. Here's a statistic that should alarm every policymaker. Nearly 25% of American households routinely find themselves unable to cover basic monthly expenses, while approximately half maintain little to no emergency savings to cushion themselves against escalating costs. But here's where it gets truly controversial. This financial vulnerability isn't confined to traditionally low-income demographics. Shocking research reveals that more than 1/3 of adjustable-rate mortgage holders earning over $100,000 annually report living paycheck to paycheck. This data completely destroys the myth that high earnings automatically guarantee financial security in today's economy. Across all income levels, families are making increasingly desperate choices, postponing major purchases indefinitely, slashing discretionary spending to bare minimum levels, and relying heavily on buy now, pay later services or credit cards just to maintain basic cash flow. The question we should be asking is, if six-figure earners are struggling, what hope do middle and lower income families have? Why the Fed's move won't help yet? The September rate reduction establishes the federal funds target range between 4% and 4.25%. A relatively modest adjustment following more than 12 months of maintaining elevated rates to combat stubborn inflation. However, Federal Reserve research consistently demonstrates that interest rate modifications move through the economic system at a frustratingly slow pace. Here's the reality check most financial advisors won't tell you. The most immediate benefits typically apply only to adjustable-rate financial products, such as certain mortgage types. For the credit cards and fixed-term loans that dominate most families' debt portfolios, including auto payments, Interest rates remain contractually locked and resist downward movement. A timeline for meaningful relief could extend several months before households witness reduced minimum payment requirements or access improved refinancing opportunities. During this waiting period, existing credit card balances continue accumulating interest at punishing rates. For paycheck-to-paycheck consumers, tangible financial relief may not materialize until late 2025 or even beyond, depending entirely on the Federal Reserve's future policy decisions and their implementation speed. Consumers care about rates more than banks realize. Interest rates represent far more than abstract economic indicators for struggling households. They fundamentally determine banking relationships, borrowing decisions, and overall financial security perspectives. Comprehensive research reveals that 66% of consumers identify competitive interest rates as a primary consideration when selecting financial institutions. Yet this concern reveals a troubling stratification that deserves more attention. Families operating on extremely tight budgets prioritize minimizing fees for essential banking services, while financially comfortable savers and strategic borrowers actively seek optimal yields or the most favorable annual percentage rates. The research also exposes a significant knowledge divide that financial institutions seem to ignore. Financially stable consumers demonstrate greater accuracy in predicting interest rate movements and view elevated rates as potential investment opportunities. Meanwhile, those experiencing financial stress approach credit with extreme caution, dramatically reducing spending to avoid additional interest expenses. The BNPL revolution nobody saw coming. As consumers navigate persistent economic uncertainty, one payment solution continues demonstrating remarkable resilience and will likely maintain its dominant position regardless of interest rate fluctuations: buy now, pay later services. But here's where it gets controversial again. Are these services actually helping families manage their finances? Or are they simply creating new forms of debt dependency that traditional credit reporting doesn't capture? Meanwhile, traditional banks find themselves competing intensely on rate offerings, while American consumers desperately search for even minimal budgetary relief. The uncomfortable question we need to discuss: is the Federal Reserve's monetary policy actually creating a two-tiered financial system where rate cuts benefit the wealthy while leaving struggling families further behind? And if BNPL services are becoming the primary financial lifeline for millions of Americans, shouldn't we be questioning whether our entire approach to consumer credit needs fundamental restructuring? What do you think? Are rate cuts just another example of policies that sound good but fail to help the people who need assistance most? Share your thoughts and experiences in the comments below.